Every bull run needs a token narrative to help get those rocket boosters ignited. A new technology, a new token model. The markets need something to get excited about, or a bull run won't happen. So what's going to be the next big narrative to help push the markets off of these lows? We'll find out in about 10 minutes, because it's time for Chico Crypto. So, if we go back in the history of cryptocurrency, every bull run had some technological achievement or narrative that helped move the markets forward. The creation of Bitcoin in 2009 was the first one. BTC's new idea of a decentralized money helped move the markets forward, creating bull runs in 2011 and into early 2013. But throughout 2013, the technology started advancing and advancing quickly. By mid-2013, altcoins were starting to be created. Using Wayback Machine to check out coin market cap from May of 2013, we can see there were 13 other cryptos besides Bitcoin. But by the end of 2013, we can see that list grew to a total of 41 coins. The introduction of altcoins helped create the bull run that happened at the end of 2013. The 2017 bull run was kicked off by the introduction of the ERC20 token built on Ethereum. Before this, it was much more complicated to create a token. You had to fork Bitcoin, or you had to create your own consensus mechanism. And if you forked BTC, you needed to find hash power. ERC20 let anyone with minimal technical skills create a token, which led to an explosion in tokens and thus the crypto market cap. Checking out coin market cap at the end of 2017, we can see there were over 1,500 crypto tokens out there. So what were the next hype cycles after this? Well, I actually called this before it happened. In December of 2019, I made this video. DeFi, decentralized finance, will lead the bull run charge. And shortly after, January of 2020, I made this video. Ethereum DeFi tool to spark the next bull run? Uniswap. And as we know, we had the DeFi summer of 2020, pushing the markets back past 20K by the end of the year. And then finally, we had NFTs, alternative layer 1s, and Metaverse, which helped finish off this last bull run we experienced. But the hype of all of these has faded, and the markets have crashed again. So what is going to be next? What will be the crypto narrative which gets the markets off of these low lows? Well, I have a feeling it has to do with DeFi once again, but DeFi in a much more sustainable and real way. I'm talking about real yield DeFi projects. DeFi got crazy this last bull run, with projects coming out left and right who promised outrageous APYs, yield that was unsustainable, usually through token inflation, which ended up obliterating the token's price, only serving to dilute its value. But over the past 9 months, we have been seeing a new trend hit the DeFi scenes called real yield. You can think of real yield as a revenue sharing token model. Protocols with real yield share the protocol revenue with their token holders in the form of their token, stablecoins, or the layer 1 protocol token they are using, like paying out in Ethereum. And real yield projects are defying this bear market. One of the first real yield projects to hit the scene was GMX. GMX came out in October of last year. It hit a peak of $58 by January of this year. And as we can see today, GMX is pushing back up towards $50, which means GMX is already almost back to its all-time high, while a majority of altcoins are down 70% or more. So how does GMX work? What's the reason for this explosion? Well, GMX is a decentralized perpetual exchange where you can go long or short on various crypto assets with up to 30x leverage, and it's built on multiple chains. So far, Ethereum Layer 2 Arbitrum and Avalanche. Now, the revenue and fees made from trading on GMX are stacking up and stacking up big time. GMX has moved into the number 4 position on crypto fees, averaging over $401,000 per day for the last 7 days, pushing it above the DeFi gem Uniswap. Checking out the GMX Twitter's last post, over $2.8 million was collected in revenue for the past week. and 100% of that revenue gets distributed to token stakers and holders. Looking at this graphic on how GMX revenue and tokenomics work, we can see GMX token stakers earn 30% of the revenue and protocol emissions, while GLP holders, the protocol's liquidity token, earn 70% of the revenue and protocol emissions. GMX is a platform for the people, which is even seen in their token distribution. As we can see, only 250,000 out of the 13.25 million tokens of GMX are reserved for the team and contributors, aka less than 2% of the token supply. GMX started the real yield trend, and now there are other projects implementing this revenue strategy, and this will be my first time covering these new real yield DeFi projects. And the next one I have to cover is Gains Network, as it's one of the most feared GMX competitors to hit the market. Gains Network is developing G-Trade, a decentralized perpetual exchange built on Polygon. Compared with its competitor GMX, this platform has one distinct advantage. The leverage is synthetic, meaning the protocol can have any trading pair listed as long as there's an oracle that tracks the price of the pair assets, which means many more assets can be traded on Gains, even stonks and Forex. GMX is introducing synthetic leverage as well soon, but for now, Gains has this advantage. Gains is similar to GMX, but they also have one other distinct difference. The trades and collateral of the system are backed by a DAI vault, which means the protocol revenue is paid out in DAI. Now, checking out their July revenue distribution sheet, we can see revenue is split between many more entities than GMX. 19% is distributed to NFT bots, 15% is given to the governance fund, 23% goes to the GNS DAI LPs, 15% goes to the development fund, and 23% goes to the DAI stakers. So 30% of the fees are going to governance and development treasury, while 70% of the fees are going to stakers and LPs. Although Gains compared with GMX has a lot of room to grow. GMX is ranked number 115 on CoinGecko with a market cap of over 369 million. Gains is ranked 409 with a market cap of under 50 million. And the final real yield project I'd like to cover is Umami Finance, as they have really leaned into the real yield narrative. Initially, Umami was an ohm fork that offered huge unstakeable rewards for staking Umami. But a few months ago, the community agreed through a governance vote to stop the Umami emissions and pivot to a platform providing real yield. As we can see from their app, they have two popular products, Marinate and Compound, which is paid out in wrapped Ethereum rewards. And they even have a USDC vault coming soon, which will provide sustainable 20% APY on your USDC. And the thing I love about this, they utilize GMX. From the description of this vault, they say, the Umami USDC vault generates yield by providing liquidity to GMX's leverage perpetual exchange and safeguards against market volatility using non-liquidable hedges from Tracer. So how much of Umami's platform's revenue is distributed to the users? Well, checking out their docs, we can see they say, currently, Umami uses approximately 1/2 of the monthly yield from its POL to pay out the ETH passive income to its Umami marinators. As protocol revenue from products such as Umami's USDC vault continue to increase, Umami will transition to paying its marinators from product fees. So out of these three real yield projects, GMX leads the pack, paying out 100% to users. Next is Gains paying out 70%, and finally Umami pays out 50%. But there are many other real yield projects out there, like the big dog Synthetic, who pays out 100% of the fees to SNX stakers. There's Redacted Cartel, Looks Rare, Perpetual Protocol, DYDX, and Kujira on Cosmos. And I'm sure as this narrative picks up steam, there will be many others. And you know your boy Chico will be the first to spot them. Cheers, viewers. I'll see you next time.